All right, welcome to Coffee Talk. This is Scott Gwatney, Gerrod Galliano talking to you today about the market, the current state of the market, but most importantly, these trials and tribulations of what do we do in terms of timing?
Right.
Do we try to time it? Do we not try to time it? What do we do at different ages?
How to make money.
How to make money. This is a difficult market. Some call it a sideways market, slightly positive in 2023 so far. Yeah. But we're just coming off the heels of a very scary year in 2022 with a lot of the same echoes of patterns. So.
Up and down. So, I would start with that. Just how would an investor invest in this market? And I tell everyone it depends on the investor. And I say that because if you're younger and you're just slowly buying in, that just continue to buy. 5-10 years from now, you'll be happy you bought in now. We see clients that are still kind of growing towards retirement, that 10-year window, and that's a little bit differently on how aggressive they want to be. And I know you've seen it too. We have clients that are already retired. They're already invested. Their money's already put to work for them. How do they invest? And my thing has just been sticking to a plan, a posture. If we're going to dollar cost average, stick to that plan. Don't try to jump in just because the market takes off, because we've seen it just like that. Bad news, and then we can be right back in a knee-jerk reaction. So I think staying disciplined, putting a plan together is kind of two, and then sitting with an advisor and really just taking a look at things. And for those that are already retired, maybe diversifying. If you haven't diversified, there's different tools and different avenues to earn money and protect money in this market. And I know that you know a lot about those, and you've talked to your clients about those options.
So let's talk about dollar cost averaging, because this is something people throw around like a common experience in terms of putting a little bit in at a time versus going all in. But let's go over a real example. For instance, if you have $100,000 or $200,000 in cash and maybe a $500,000 portfolio, so you have a good 30-40% of your money that, for whatever reason, you set it aside. Maybe it was inherited, but it's in cash. So you want to get back in. What's a realistic kind of time horizon that you would suggest, Scott, for kind of building back into being fully invested?
I'm more cautious in this market, mainly because, if we were back 2 years ago where you're earning 0.1% sitting in cash, and we're taking, 2 to 3 months to put that money to work, that's 2 or 3 months and that money's not earning anything. Right. I'm okay taking smaller bites now because we're getting, roughly 4.5% money markets just sitting in cash.
That's true.
It's safe. So I'm okay taking a more cautious approach. I still think something along that line, a third of a portfolio that we need to put to work. I would do it every couple weeks. That's just kind of my theory. Now, how much? Depends on how much, what we're looking at client-wise. Are we adding aggressively? Or are we looking for just blue chips? Like, how are we investing that third? I think that determines, too, the frequency or how quickly you want to get it into the market.
Yeah, so I actually think along the same lines, and with all the computer trades that are all stacked on top of each other with these set puts and calls, the computers aren't running like a Terminator where they're just making decisions. Right. It's just people are setting all these moments on maybe 200-day, 100-day moving averages, and you'll see these cascade effects. So the market is more, I guess, momentum up and down than we've seen in the past. Yeah. So you'll have these really good weeks, these really bad weeks. Just keep that in mind if you're looking at moving big chunks, that you can probably be a little patient. Even in an up market like this, we're up 7 or 8% now, and we're a quarter through the year. Yeah. Well, that can turn real quick in today's type of market.
It can, and I think back to kind of diversifying what we mentioned earlier is not only just investment wise, because now CDs are attractive, in which we have a plethora of being able to offer CDs. The money market accounts are back to actually producing some sort of income in that 3 to 4% range. Your stocks, your bonds, even your annuities. I really think, after through last year, clients need to figure out, this one thing we sit down and talk to clients about is how much protection do you want and what kind of protection. It all comes down to time horizon and what's this money going to be used for. Are we looking at 3 to 5, 10 years down the road? Or are we looking at just cash that we're looking to build a house next year? And I think those questions when we sit down with a client and figure out their time horizons for each bucket of money, even if that's how they think, that determines what type of vehicle we want to use to get them there.
All right, so we kind of helped out the 30 to 50-year-old who's looking to get in. We say you need to be mostly in. You're not trying to time the market too much. but you don't need to go all in at once. You still can take your time because of the fixed rate that's available. Let's talk about more of you called it quits. This is how much you have saved, retiree. You're 63, you're 65, and you have to decide, do I even want to be in this market right now? People are coming to us.
Right.
They have a lot of fears. There's so many. We can name them, but everybody knows the inflation, the Corona version too, the Russia, Ukraine. There's so many things out there.
Banking.
The dollar, countries moving away. But it feels really scary, but we like to be a little more, I guess, historical and reminding folks that there's lots of scary times in the past.
There are, and I think that determines, sitting down with each individual client, it's the portfolio they have built, especially the retired clients, is if we truly take all the chips off the table, or we take 80% off and we do something like an annuity, CD ladder, or money market earning 3 or 4%, the biggest question is the retirement lifestyle that the clients look to have, that you want to have. Are we able to still maintain that lifestyle just taking the chips off the table? The market's average roughly 7-8%, depending on how you're invested, but just moderate. If we go back to 4, that's almost half of just the income generated in CDs, and money markets don't grow like the stock market. So that's something that when we sit down with a client is it better to put into something like that? Is it better to put in a tool like a fixed index annuity that has protection, still has growth potential? That's some of the things that we need to sit down with those clients, especially in that age range, and say, okay, I know that we're a little scared, but maybe we just reallocate what type of companies, even in the stock portion that we want to grow. We don't do so much tech. Maybe we go more towards big blue chip, oil, natural gas, financials, something like that. It's going to pay a pretty solid dividend and still have the opportunity to grow over the next 10, 20 years.
Yeah, it's exactly right. So what Scott's really alluding to with all that is, you could sum it up with one word, and it's why. Why be in the market? Well, there's good reasons to be, and there's good reasons not to be. We're here to help you analyze that. Right. It's what you need to think always as an investor is, don't try to just ask yourself what's the best places in the market. Just why do it? Maybe you need to make the money to keep up with inflation, or maybe you don't. Maybe you're there already. And that's why it's so important to take a step back, really look at things, and don't mess it up if you made it.
Yeah, just analyze your situation and things like that. So I think that's a good topic to sit down and talk to everyone about. And before we leave, just want to touch base. We touched on it earlier about banks and that being fear driven. And we saw earlier this year a couple of them go under. I keep telling clients the same thing. Look, you got to check them back, not only the bank, but the credit quality. And I mean, the large banks, they have so much in reserves. They're so regulated. I mean, even here locally, I can't think of anything that really has me of concern that's in the same situation as the two over in California. I tell everyone it's not as big of a concern as I think it's been taken on. But of course, we always know if you throw it on the red line on the news ticker, everyone's talking about it. And as soon as they take something to run, one of the things I would tell everyone is give us a call, give your advisor a call. If there's a question about banks, tech companies, anything like that, I always tell them to reduce those fears, give us a call, and let's talk about the specific situation, companies, or what's going on in the news.
No, you're right. And when we think in terms of probabilities, and we say how many banks have failed in the past 20 years in the current kind of environment we're in, and you run that on the total number of banks in business, and you crunch the numbers, and you say, wow, I'm more likely to have a jet drop an engine on me. The truth is, it's a real fear, and you should consider it. You should always consider maybe it's a trend and something to be concerned about and aware of, but also don't overinflate it, and don't make any crazy knee-jerk moves that could harm you long term by burying it in the coffee cans and then forgetting where you buried the money. That's not actually an improvement on things.
That's what I would do. It's like a squirrel. I'd put a nut in the ground and forget where I put it. So that'd be my luck.
Yeah, exactly.
Somewhere in the backyard. Well, no. Once again, Gerrod, thanks for having us. Thanks for joining us today. And once again, just if you have any questions, always reach out to call us. That's kind of where I wanted to go with everyone is, watch the monthly bombs that Ernie sends out, and just if there's any questions, concerns, don't ever hesitate to give us a call here at Burns Estate Planning Wealth Advisors.
Yep. Thanks, guys.
Thanks.